incurred during construction? What do you do with interest that's incurred during construction? Do you capitalize it or not capitalize it? No, you don't capitalize, and that's one of the things you have to keep in mind. So if you're incurring interest during construction, don't capitalize the interest. Okay, a couple of other things. I won't talk about this accrued interest. Everybody know what accrued interest is? By the way, do you take a course in finance in this class, in this program? So you've learned how to calculate accrued interest. And, okay. So, oh, here's the slide. Oops, sorry. I thought it wasn't, but here. Interest costs incurred during construction are not capitalized. Always shown as an expense or as an expenditure. Very different from what we're used to. So just remember that. Yeah?
This is only for government projects, so
yeah.
Private?
No, just for government. This is just for governmental projects which are run through Capital Projects Fund. Do you understand that?
Okay.
Yeah. Only for those. If it were business type of activities where they're doing it on full accrual basis, they would recognize it, but only for governmental funds.
So would you consider something like an MTA project?
An MTA project?
Yeah.
If it's classified as a business type activity, then they would. But in the case of MTA, it is actually classified as a business type activity, so it would be capitalized.
Even though government funds are subsidized?
Yes, but it's run as a business.
Okay.
Yeah.
So in terms of freedom tab, want to be a business type, even though the tab.
Yes, and we're going to talk about this in the next chapter, in chapter 7, about those type of activities and how do you classify whether it's a business type or a governmental activity. Okay, basically, it should be the intent of the government to run it as a business type activity. If it is, then it can be classified as business type activity. Yeah. Okay, a couple of other things, arbitrage, rebate, and all I can tell you about this is, and this really belongs more in the next topic rather than here, but if you were the CFO of a governmental entity, you could have a perpetual money-making machine. How do you do that? You borrow money at tax-exempt rate, and what do? Invest it at higher rates. And you've got a money-churning machine. Just keep on borrowing. You borrow money at 1%, invest it at 2 or 3%, and you can do this forever. Does the federal government like that? No. And that's called arbitrage rebate. The difference between what you're borrowing and what you're investing. And read this slide, which is what it does is that the federal government has this rule that if you make money beyond what the regs say, for instance, things like if you spend, you need to spend all the proceeds on the tax-exempt bond within a certain period of time. If you do that, and even if you make money, you don't have to worry about it, like within 6 months or so, okay? Or if it's 85% of the bond proceeds are spent within 3 years, you don't have to worry about it. But if you don't need those, any extra money that you make has to go back to the federal government. So, and you're, as an auditor, you will be auditing those calculations, the arbitrage. And I won't go into the calculation, but it's not really rocket science because all it is comparing what your return was as opposed to what your cost of debt was. You want it to be very equal. And what they have is, I don't know if the Treasury still does that. I know we used to do this. They're called slugs, state and local investments, where basically what you do is you invest your bond proceeds with a special fund run by the US Treasury, which gives you minuscule amount. So you don't run afoul of the arbitrage rebate regulations. You can have projects. If you have 3 building projects, could you have 3 capital projects? Yes. Could you have capital projects which run over several years? Yes. This is what it talks about. And special assessment, as I said, one is paid by general taxpayers, and the other is paid by those who benefit. And basically, and we'll, again, I'll hold off on this because we'll talk about this more in Chapter 8. So that is Chapter 5. And we tried to hit on all the important pieces. Let's do one thing now. Let's take a quick look at our, actually, let's take a quick look at our homework. Take a break and then here. Okay, so now the last of the governmental funds, which is the debt service fund and the general long-term liabilities. Notice the use of the word general.